A month after Moody's lowered the outlook on its AAA credit rating on U.S. government debt from stable to negative, it did the same to its A1 rating on Chinese government debt this week. More interesting than Moody's decision was the reaction from Beijing that was surprisingly restrained. The Chinese Ministry of Finance only expressed disappointment, while a foreign ministry spokesperson said that China is capable of deepening reforms and addressing its challenges and welcome friends from all over the world to invest in China. Is it possible that China is finally acknowledging that there is a problem? If so, should we see this as a positive or negative sign? What does China have to do to steer its economy away from the brink of disaster? Hi, I'm David Wu, a former IMF economist and Wall Street strategist with a 20-year track record of making actionable predictions about the big stories shaping our world tomorrow. The Chinese state media has been taking a new tone towards the US lately, with less negative coverage, calls for a return to warmer ties, and stories of Americans with positive connections to the country. Stories such as a recent trip by members of the Philadelphia Orchestra to mark the 50th anniversary of its 1973 trip to China that helped build then-fledgling US-China ties. Or the visit by members of the Flying Tigers, a group of American military pilots who helped China fight Japan in World War II. On the eve of President Xi Jinping's trip to the US last month, the People's Daily wrote that the Chinese people will never forget an old friend, and that's an important message we want to send to the American people. Even Xi's sudden decision to travel to the US took many people by surprise, especially given in the weeks leading up to his decision, Washington had widened the sanctions on the export of AI chips to China and approved the first ever military aid to Taiwan. In the US, Xi agreed to restore the military hotline between the two countries that China cut off last year in protest of the Pelosi visit to Taiwan. He also agreed to directly target companies that are producing precursor chemicals for the production of fentanyl that Washington wants to stop coming into the US. It was not clear what Xi got in return, but that did not stop the usually confrontational Global Times to call it a strategic, historic, and directional summit. Are US-China relations improving? I don't know, but what I do know is that China has decided to play nice. I'm not sure why, but I suspect it has something to do with the Chinese economy. I suspect the Chinese leadership has finally realized the depth of the economic crisis at hand. I suspect the Chinese leadership has decided that at least at this moment in time, China needs the US more than the other way around. A symptom of both China's economic troubles and worsening US-China relations is a dramatic deterioration of China's net direct foreign investment balance. Foreign firms pulled more than $160 billion in retained earnings from China during 6 successive quarters through the end of September. Meanwhile, China's share of the biggest market for its exports continues to shrink. US imports from China is now less than 14% of total US imports, the lowest level in nearly 20 years. And it is not only the US where Chinese exporters are seeing reduced demand. Chinese exports to Europe and even to Southeast Asia have fallen by 15% over the past year. The decline in Chinese exports over the past year is not as severe as what happened in 2008 and 2009, but then the world is not in a recession like it was then. China is still the world's largest exporter, and its exports got a big boost during the lockdown, but its market share in global trade is sliding back. Walmart, the world's largest retailer, imported 60% of its foreign-produced goods from China in the first 8 months of this year, down from 80% for the same period in 2018. In contrast, 20% of Walmart's imports came from India, up from 2% in 2018. Slowing demand for Chinese goods is weighing on Chinese manufacturing and growth more generally. China's Purchasing Manager survey for the manufacturing industry shows that over the past year, export orders have been contracting much faster than domestic orders. I'm tempted to think that China's softening tone in its dealing with the US is calculated to slow down foreign capital outflows in the relocation of global supply chains. It is unlikely to be a coincidence that China held its first ever international supply chain expo 2 weeks after she got back from the US. China's spectacular economic growth over the past 20 years had a lot to do with its ability to sustain faster export growth than global trade growth. With exports still accounting for 20% of Chinese GDP, and average annual global trade growth at just 2%, China cannot afford to lose its global market share if it's to maintain 4 to 5% GDP growth over the next 10 years. I suspect this was why Xi Jinping decided to swallow his pride and went to the US to buy time. He needs a timeout with the US so that he can focus on the problems at home, problems that he could no longer pretend will go away by themselves. The fact that lockdown has been lifted for nearly a year and Chinese consumer confidence remains at a 20-year low has to be making Xi Jinping very nervous. I know I would be if I were in his shoes. Forget about what depressed consumer confidence says about public approval of his job performance. Depressed consumer confidence is causing Chinese consumers to sit on their vast savings as opposed to spend. Slowing retail sales over the past 6 months bears out this hesitancy clearly. The fact that visits by Chinese tourists to sunny and welcoming Thailand are barely 1/4 of where they were before the lockdown says that Chinese demand for services is not much stronger than for goods. China is facing both weak foreign and domestic demand. In the past, when China faced weak foreign demand, it was always able to stimulate domestic demand to compensate. This time, stimulus has been less effective. For example, despite mortgage rates are at an all-time low, demand for mortgages has collapsed. Incredibly, total household mortgages have not gone up in the last 20 months. Why is stimulus not working? What is the bottleneck? What should China do? And what is it doing about it? Everyone knows that the Chinese housing market is in big trouble. But with minimum down payment requirements of 20% for first-time homebuyers and 30% for second home buyers, the main risk associated with China's housing crisis is not widespread mortgage defaults like we saw in the US during the housing crisis of 2008 and 9. Yes, China's housing crisis is not about the ability or willingness of Chinese homeowners to service their mortgages. China's housing crisis is all about the solvency and creditworthiness of Chinese property developers. As you probably know, China Evergrande, once China's largest developer and with $300 billion of outstanding debt, defaulted in 2021. Since then, 46 other developers have defaulted. China Evergrande spent the past 2 years trying to restructure its debt with creditors, and it's been unsuccessful so far. Meanwhile, Evergrande's problems are getting bigger with every day that passes. A new auditor said in July that Evergrande had lost a combined $81 billion in 2021 and 2022. That compared with what the company said in 2020 was a profit of $1 billion. There's been a lot of talk about accounting irregularities, fraud, and weakness of China's corporate governance system. But fixing the governance system is not going to solve China's housing problem right now. To fix the housing problem, we need a quick solution for Evergrande and other troubled developers that become the bottleneck for the entire Chinese economy. Bottleneck because these developers can no longer access liquidity. In other words, nobody will lend them any more money. And without money, they cannot complete the apartment buildings that they started building. Nomura Securities recently estimated that there are 20 million units of such apartments right now. While they're sitting on millions of unfinished apartments that produce no income, their debt is still growing from unpaid interest. Meanwhile, many people who bought one of these unfinished apartments are in a serious bind, with no recourse to recover their life's savings. People who want to buy a home are hesitant to buy pre-sold apartments. This makes it even more difficult for developers to raise money for new projects. As a result, home sales are down 50% from 2021, and housing starts even more. Even with fewer new buildings completed, prices of new residential buildings are still falling. I can go on, but you get the point. The entire housing market is stuck. At its peak, the Chinese housing market was contributing about 20 to 25% of GDP. Evergrande and other troubled developers have become the biggest drag on the Chinese economy. It is shocking that Beijing has lost so much precious time by allowing Evergrande so much leeway to find a way out on its own. But recent developments suggest that Xi Jinping may be ready to bite the bullet finally. Time is money. I can understand why Beijing has been relying on the market to find a solution to the troubled developers. But market solutions are not necessarily the best solution in this situation. The creditors of China Evergrande are demanding a liquidation of the company. But unfinished apartments are not easy to sell. Liquidation would mean a fire sale that could shake confidence further in the property market. I can understand also the desire to punish the owners and management of these developers. But justice is a luxury that China cannot afford right now. I can also understand why Beijing does not want to build out the foreign creditors of the developers. But in a crisis, you do what you have to and not what you want to do. There are signs in recent weeks that Xi Jinping and his team are moving in a new direction. There are reports that Beijing is demanding state-owned banks to provide unsecured loans to a list of 50 developers to complete their unfinished apartments. The same report suggests that Beijing has agreed not to hold the banks responsible if they cannot recover the loans later on. The implication is that Beijing is prepared to inject capital into the banks if it becomes necessary later on. I see this as targeted fiscal stimulus designed to unlock the frozen housing market. In my judgment, this is a pragmatic move in the right direction. Let's hope it's not too late. Thank you for listening. If you haven't done so already, please subscribe to my YouTube channel, and most importantly, hit the bell so you would receive a notification when my next video comes out. If you want to learn more about my investment strategy, come visit us at davidwunbound.com.